Cryptocurrency perpetuals are the dominant derivatives traded in crypto markets. They provide exposure to rising or falling prices without requiring ownership of the underlying cryptocurrency. They remain open without an expiration date and use recurring funding payments to stay connected with the spot market. A derivative is a financial contract whose value depends on an underlying asset. The underlying asset is the asset's price the contract follows. A spot transaction buys or sells the underlying asset for immediate settlement. The spot price is its current market price. A cryptocurrency perpetual is an open-ended, margin-based derivative. It provides synthetic long or short exposure to a crypto asset and replaces expiry-based settlement with recurring funding payments. Synthetic exposure means receiving the economic gains or losses from an asset's price movement without owning the asset itself. A long position benefits when the price rises. A short position benefits when the price falls. Today, we will explain how perpetuals work, why they need funding, and how margin, leverage, collateral, liquidation, and contract design create both opportunities and risks. Professor, before we begin, please introduce EIM and explain why this topic matters in its doctoral programs.
I serve as a dissertation advisor in the doctoral programs at EIM, the European Institute of Management, and have advised more than 100 dissertations. EIM offers fully online MFHAA accredited doctoral programs at MQF and EQF Level 8 in management, healthcare studies, computer science and engineering, and business administration, as well as a dissertation completion pathway. The programs are designed for working professionals and combine structured research education with individual dissertation supervision. The aim is not only to complete a doctoral degree, but to produce rigorous, relevant, and defensible research. Further information is available at eim.education. The topic discussed today sits at the intersection of finance, technology, market design, and regulation, which is one of EIM's research focuses.
What is the basic difference between buying cryptocurrency and trading a perpetual?
In the spot market, you purchase the underlying cryptocurrency. With a derivative, you obtain contractual exposure to its price. A standard futures contract has a fixed maturity date. Maturity, also called expiry, is the date on which the contract ends. At maturity, settlement completes the contract through asset delivery or cash payment. To continue the exposure, the trader performs a rollover, meaning the replacement of the expiring contract with a later one. A perpetual removes the fixed maturity date. The position remains open until it is offset, liquidated, or terminated. To offset a position means to enter an opposite transaction that closes the original exposure.
So, a standard futures contract ends on a specified date, while a perpetual contract is open-ended and eliminates the need for repeated rollovers.
Exactly. The terms perpetual future and perpetual swap are often used interchangeably. The product resembles a futures contract because it provides standardized exposure and is marked to market. It has swap-like features because long and short positions exchange recurring payments without receiving the underlying asset. A swap is a derivative in which the parties exchange payments according to a defined rule. The paper therefore uses perpetual as the general term, and it also warns that the market label does not determine the legal classification.
A standard future moves toward the spot price as expiry approaches. What keeps a perpetual connected with spot?
The funding mechanism. A funding payment is a recurring transfer between traders holding long and short positions. The funding rate follows the contract rules. It commonly reflects the difference between the perpetual price and a reference spot price, and may include an interest rate component. When the perpetual trades above the spot reference, funding is typically positive, and long traders pay short traders. When it trades below the spot reference, funding is typically negative, and short traders pay long traders. Many venues apply funding every 8 hours, but the interval and formula vary.
Funding is therefore the payment system that replaces the convergence pressure created by expiry.
Correct. Funding encourages traders to take the opposite side of price differentials, but it does not guarantee equality with the spot price at a specific time. No final settlement date forces exact convergence, so the funding formula is a central part of contract design. A funding clamp is a rule that limits or modifies the funding calculation when the difference between the perpetual and spot prices becomes unusually small or large. In other words, a clamp changes the extent to which the funding rate responds under particular market conditions.
How can traders control positions larger than the money they deposit?
Through margin and leverage. Margin is collateral deposited to support a derivative position. Collateral is an asset pledged to cover possible losses. Leverage means controlling exposure whose value exceeds the collateral posted. For example, $1,000 of margin at 5 times leverage creates approximately $5,000 of exposure.
Margin is the collateral supporting the position, while leverage enlarges the exposure relative to that collateral.
Correct. Leverage magnifies gains and losses. Perpetual positions are continuously marked to market. Mark to market means recalculating profit and loss as the relevant market price changes. Exchanges commonly use a mark price rather than only the last traded price. A mark price is an exchange-defined reference used to calculate profit, loss, and liquidation thresholds. It is often linked to a spot index. A spot index combines prices from one or more spot markets into a reference value.
The mark price is therefore the exchange's risk management reference, not necessarily the most recent trade.
Exactly. The trader must maintain enough collateral to keep the position open. Maintenance margin is the minimum margin required for that purpose. If the account falls below that level, the exchange may liquidate the position. Liquidation is the forced closure of a position because the remaining collateral is insufficient.
Liquidation is the automatic exit used when a leveraged position no longer has sufficient collateral.
Correct. A highly leveraged position can be liquidated after a relatively small adverse move. The exact point depends on the venue's margin schedule, fees, mark price rule, and position characteristics. Leverage alone does not reveal it.
Do all perpetuals use the same collateral?
No. A linear perpetual is normally margined and settled in the quote currency, often a US dollar stablecoin. The quote currency is the currency in which the asset's price is stated. A stablecoin is a crypto asset designed to maintain a relatively stable value, commonly by referencing a conventional currency. In a Bitcoin to dollar market, the dollar is the quote currency, so a linear contract expresses profit and loss in dollar-like units.
A linear perpetual therefore uses the currency in which the market price is quoted.
Yes. An inverse perpetual is margined and settled in the base asset. The base asset is the asset being priced. In a Bitcoin to dollar contract, Bitcoin is the base asset. The trader posts Bitcoin and receives profit or loss in Bitcoin. Its conventional currency payoff is non-linear because both the collateral and the contract result change with the Bitcoin price. A quanto perpetual uses a third currency for margin and settlement. This creates additional exchange rate exposure, meaning risk from changes in the relative value of the currencies involved.
An inverse contract settles in the underlying crypto asset, while a quanto contract uses a third currency and introduces an additional exchange rate risk. Where are perpetuals traded?
They are traded on centralized and decentralized exchanges. A CEX is operated by a company that manages custody, order matching, margin, and liquidation. Custody means holding and controlling client assets. Most CEXs use a limit order book, which is a list of buy and sell orders organized by price.
A CEX is company-operated, and its order book brings together buy and sell orders.
Correct. A DEX implements perpetuals through smart contracts. A smart contract is blockchain-based code that automatically applies predefined rules. Some DEXs use an oracle, an external data feed that supplies a reference price. Others use a virtual automated market maker, or VAM. A VAM shifts price formation from a conventional order book to programmed inventory and pricing rules.
A DEX relies on automated contract rules. An oracle supplies external prices, while a VAM uses an algorithm instead of a conventional order book.
Exactly. The risk structure differs. CEX users depend on the operator's custody, reporting, and internal risk engine. DEX users depend more on smart contract security, Oracle quality, blockchain operations, and automated liquidation. Decentralization changes risk, it does not remove it.
Could you describe one complete perpetual position?
Suppose a trader expects Bitcoin to rise. The trader enters a long Bitcoin perpetual, posts margin, chooses the position size and leverage, and then receives gains or losses as the mark price changes. At each funding interval, the trader may pay or receive funding. The trader can close the position voluntarily by offsetting it. If the account falls below the margin requirement, the exchange may liquidate it.
So the position begins with margin and leverage, changes with the market price, exchanges funding, and ends through offset, liquidation, or termination.
Correct. Another important measure is open interest. Open interest is outstanding derivative exposure. Depending on the venue, it may be reported as contracts or notional value. Notional value is the reference value of the exposure controlled by the contract. Open interest differs from trading volume, which measures how much was traded during a period.
Open interest measures outstanding exposure, while trading volume measures activity during a period.
Exactly. The paper cautions that open interest reporting is not standardized and may be inaccurate, weakening external assessment of participation, collateral needs, and risk.
What is the basis?
The basis is the difference between the perpetual price and the spot price. Basis risk is the risk that this difference changes unexpectedly. A standard future has terminal settlement. A perpetual has funding pressure but no terminal convergence state, so its basis may remain positive or negative because of funding rules, interest rates, fees, margin requirements, and limited arbitrage capital.
The basis is the price gap between the perpetual contract and the spot contract. Basis risk is the possibility that the gap moves against the trader.
Correct. Arbitrage is a strategy that seeks to profit from price differences between related markets. A standard example is to buy the cryptocurrency in the spot market and short the perpetual when it trades above spot. The trader may receive positive funding while reducing directional exposure. But this is not risk-free. Funding can change, fees can remove the expected return, the basis can widen before it narrows, and the leveraged short position can be liquidated. The paper describes this as random maturity arbitrage. Random maturity means the time required to unwind the trade is uncertain, as no expiry date forces convergence.
Arbitrage seeks to profit from price differences, but random maturities mean the closing time is uncertain and liquidation can occur first.
Exactly. A persistent basis, therefore, is not automatically an obvious pricing error. It can reflect funding design, transaction costs, capital constraints, and liquidation risk.
What should a beginner remember before considering a perpetual?
First, a perpetual is a derivative, not ownership of cryptocurrency. Second, funding is not guaranteed income. The rate can change and the trader may pay it. Third, leverage increases liquidation risk. Fourth, the mark price, not necessarily the last trade, may determine liquidation. Fifth, linear, inverse, and quanto contracts have different collateral and payoff structures. Sixth, a DEX is not automatically safer than a CEX. Its risks are different. Seventh, arbitrage is not risk-free because convergence has no fixed date. Eighth, the market label does not settle the legal classification.
So the trader must understand more than the expected direction of the cryptocurrency price.
Exactly. Funding, collateral, leverage, venue design, mark price rules, and liquidation can determine the outcome even when the broader market view is eventually correct. The paper describes the product economically as a hybrid derivative. A hybrid derivative combines characteristics associated with more than one conventional category contract. It resembles a futures contract because it provides standardized exposure and is marked to market. It resembles a swap because participants exchange cash flows without acquiring ownership of the underlying asset. Its formal legal classification remains jurisdiction-specific.
So a hybrid derivative therefore combines futures-like and swap-like features, while its legal treatment depends on the applicable rules and contract design. Let us finish with the central points. A spot transaction involves the underlying cryptocurrency. A standard future has a fixed maturity and terminal settlement. A perpetual is an open-ended margin-based derivative. It provides synthetic long or short exposure. Funding replaces expiry-based convergence. The mark price supports profit and loss calculation and liquidation. Margin secures the position. Leverage enlarges the exposure, and liquidation closes the position when the remaining collateral becomes insufficient.
Exactly. Perpetuals became dominant because they provide continuous exposure without repeated rollovers and concentrate trading in a single open-ended contract. But their operation depends on several interacting design choices: the funding formula, the mark price rule, the margin schedule, the collateral currency, the selected leverage, the exchange architecture, and the liquidation engine. The most important beginner lesson is not how to maximize leverage. It's about understanding the full contract before opening a position.
This conversation was based on the PGRI working paper, Fundamentals of Cryptocurrency Perpetual Futures and Swaps, by Michael Neubert, Wolfgang Rams, Patrick Gruhn, and Marcel Loetscher. The complete reference appears in the episode description. Thank you for listening to EIM Academic Insights.